The silver rocket just ignited. On Bombshell inflation report, but beware of this, because what looks like the beginning of a historic breakout may actually be hiding a much darker signal underneath. Right now, silver is moving in a way analysts haven't seen in years. Institutions are quietly repositioning, and the inflation number that just triggered this surge is not the number everyone thinks it is. By the end of this video, you will understand exactly what is unfolding behind the scenes and why the next 90 days could decide who protects their wealth and who gets caught completely off guard. Stay until the end, because Part 5 reveals the warning almost no one is talking about. Welcome back to Precious Metals Intelligence, the channel dedicated to helping serious, wealth-conscious viewers understand the strategic forces shaping the global economy. Whether you have followed this channel for years or are just discovering it today, thank you for spending this time with us. On the morning the inflation report was released, few analysts expected the numbers to move markets the way they did. For months, economists had been predicting a slow, steady cooling of price pressures across the economy. Instead, the report showed something different. Core inflation came in hotter than expected, and one specific category, a category tied closely to production costs, surged well beyond forecasts. Within minutes, trading desks around the world began adjusting their positions. Silver was one of the first assets to react. Prices jumped sharply in early trading, catching many retail investors by surprise. For a metal that had spent months trading in a relatively narrow range, this kind of sudden movement stood out. Traders who had been watching silver quietly for weeks suddenly found themselves watching a market in motion. To understand why silver reacted so strongly, it helps to understand what inflation reports actually represent to investors. When inflation rises faster than expected, it signals that the purchasing power of currency may be eroding more quickly than people had planned for. Investors who hold cash or fixed income assets begin to worry that their money will buy less in the future. Historically, this kind of worry pushes some investors toward hard assets, things that are seen as stores of value. Gold is the most familiar example, but silver, because it is priced lower and seen as more accessible, often attracts a different kind of buyer during these moments. Newer investors, smaller funds, and speculative traders looking for faster percentage gains. This is exactly what analysts observed in the hours after the report. Silver did not just rise, it rose faster in percentage terms than gold did. Some analysts called this a classic inflation hedge rotation. Others were more cautious, noting that fast, sharp moves in silver have happened before, and not all of them ended well for the investors, who jumped in during the excitement. Alongside silver, other related markets moved as well. Mining stocks tied to silver production climbed. The US dollar, which often moves in the opposite direction of precious metals, softened slightly. Gold also rose, though not as sharply. Analysts pointed out that this pattern, silver outperforming gold during a sudden inflation surprise, has occurred at several key moments in economic history. Each time, it drew significant attention from both professional and everyday investors. Financial commentators moved quickly to explain the rally to their audiences. Headlines described the move as a sign that real money was finally waking up to inflation risk. Some framed it as the start of a much larger trend, suggesting that silver could be entering a multi-month rally driven by growing concern over the economy. This narrative spread quickly across financial media, social platforms, and investment forums. For many casual observers, the story seemed simple. Inflation is back, and silver is the natural response. But experienced market watchers know that the first reaction to any major economic report is rarely the full story. Markets often move first and ask questions later. In the minutes and hours after a surprising report, prices can shift dramatically based on emotion, algorithmic trading, and short-term positioning, not necessarily on a full, careful analysis of what the data actually means. This is one of the most important lessons in financial markets. The initial move is not always the correct move. That is why, even as silver climbed and headlines celebrated the rally, a smaller group of analysts began asking different questions. Was this inflation surprise truly a sign of a lasting trend, or was it driven by temporary factors that could fade just as quickly as they appeared? Was the buying in silver coming from long-term strategic investors, or was it dominated by short-term traders chasing a fast-moving story? These questions matter because the answer determines whether this rally is the beginning of something significant or the start of a much more complicated situation. For now, the headline was clear and exciting. The silver rocket had ignited. Prices were rising. Attention was growing. And for many investors watching from the sidelines, it looked like an opportunity too good to ignore. But, as the next part of this story will show, the excitement surrounding this rally may be covering up something far more important, something that careful, wealth-conscious investors cannot afford to overlook. Beneath every exciting headline lies a set of numbers that most viewers never actually see. This is where the real story of the inflation report begins, When economists talk about inflation, they're not talking about one single number. They are talking about a basket of many different categories: housing, food, energy, medical care, and dozens of other everyday costs. Each category moves differently. Some rise quickly and then fall back down just as fast. Others stay elevated for months or even years. The category that surprised markets this time falls into a group economists call sticky costs, expenses that tend to stay high once they rise, because businesses are slow to lower prices even after conditions change. This distinction matters enormously. A temporary spike in one volatile category, like fuel prices, can fade within weeks. But a rise in a sticky category often signals something deeper, a shift that could influence pricing behavior for months to come. Analysts who studied the report closely noticed that this particular increase leaned toward the sticky side. That single detail changed the tone of the conversation, even if most headlines did not mention it. At the same time, a second layer of the story was unfolding in the silver market itself, not in the price, but in who was actually buying. Institutional investors, the large funds and firms that manage enormous amounts of money, tend to move carefully. They study data for days or weeks before shifting their positions. Retail investors, on the other hand, often react within hours, driven by headlines, social media, and the fear of missing out on a fast-moving trend. In the hours following the inflation report, data from trading platforms showed a pattern that experienced analysts recognized immediately. The early buying was overwhelmingly retail. Smaller accounts, newer traders, and short-term speculators were driving much of the volume, while larger institutional players remained relatively quiet. This does not mean institutions were ignoring the market. Many were simply watching, waiting to see whether the move would hold. History offers several examples of moments when silver spiked sharply after an economic surprise, only to give back most of those gains within days or weeks, once the initial excitement faded and steadier hands returned to evaluate the situation with more patience. One especially instructive example happened years earlier, during a different period of inflation concern. Silver surged rapidly after a similar data release, drawing enormous attention from new investors eager to protect their savings. Financial commentators at the time described it as the start of a major shift. Yet within a short period, the rally lost momentum. Prices retraced sharply, leaving many newer investors holding positions at levels far above where the market eventually settled. The lesson from that period was not that silver is a poor investment. It is that timing, driven by emotion rather than analysis, can turn a reasonable long-term idea into a costly short-term mistake. This is the pattern that cautious analysts began watching for once again. The current rally shared several characteristics with past emotional spikes: a surprising data release, rapid retail buying, heavy media attention, and a noticeable absence of steady institutional participation in the earliest hours. None of this means the rally is guaranteed to fail. Markets are complex, and multiple outcomes remain possible. But it does mean that the simple, comforting headline, "Inflation is back and silver is rising because of it," leaves out important context that serious, wealth-conscious investors need in order to make sound decisions. There's also a quieter signal worth noting. In moments like this, some professional traders begin using options and futures markets not to bet on further gains, but to protect existing positions against a possible reversal. This kind of hedging activity does not appear in typical price charts, but it often shows up in specialized market data that fewer people follow. When that kind of protective behavior increases alongside a fast, retail-driven rally, experienced analysts view it as a signal worth paying close attention to. Taken together, these details paint a more complicated picture than the headlines suggest. The inflation report was real, the price movement in silver was real, but the full explanation behind that movement, and what it might mean for the weeks ahead, requires looking past the excitement and into the structural forces shaping the market underneath. To understand where silver may be headed next, it helps to step back from the daily headlines and look at the forces that shape this market over months and years, not just hours. Silver is unlike most other assets people invest in because it sits at the intersection of two very different worlds. It is both a monetary metal, valued as a store of wealth, and an industrial metal used in real physical manufacturing. This dual identity is the key to understanding almost everything about how silver behaves. On the supply side, silver mining is a slow and complicated business. Unlike gold, which is mined mostly as a primary product, most of the world's silver comes as a byproduct of mining other metals, such as copper, lead, and zinc. This means silver production does not simply increase when silver prices rise. Mining companies cannot easily ramp up output just because demand grows, since their decisions are driven by the economics of the primary metals they are extracting. As a result, silver supply tends to stay relatively fixed in the short term, even when prices move sharply. At the same time, demand for silver has been shifting in an important way. Beyond its traditional role in jewelry and investment coins, silver has become a critical material in modern industry. It is used in solar panel manufacturing, electric vehicles, medical devices, and electronics. As governments and companies around the world continue investing in renewable energy and advanced technology, industrial demand for silver has grown steadily. Some analysts now believe the world may be using more silver each year than mining companies are able to produce, creating a structural deficit that builds up slowly over time. This supply and demand imbalance is very different from the short-term excitement caused by a single inflation report. It is a slower, quieter trend, one that does not create dramatic headlines on any single day, but one that many long-term analysts consider far more important than daily price swings. Central bank policy adds another layer to this picture. When inflation rises, investors closely watch what central banks are likely to do in response. If a central bank is expected to raise interest rates aggressively to fight inflation, that can actually work against precious metals in the short term because higher interest rates make interest-bearing assets like bonds more attractive compared to metals that pay no yield. On the other hand, if markets believe a central bank will tolerate higher inflation without raising rates quickly, precious metals often become more attractive as a form of protection. This is why the same inflation report can sometimes push silver higher and sometimes push it lower depending on how investors interpret the central bank's likely response. There's also the question of real interest rates, the difference between stated interest rates and actual inflation. When real interest rates are low or negative, holding cash becomes less appealing, and hard assets like silver tend to attract more attention. Many analysts believe this relationship, more than any single data report, is the true long-term driver of precious metals prices. Then there's the role of financial products tied to silver, such as exchange-traded funds and futures contracts. These tools allow investors to gain exposure to silver without owning the physical metal. While they make investing more accessible, they can also create short-term price swings that have little to do with the underlying physical market. Large movements in futures positioning, for example, can push prices up or down quickly, only for the market to correct once that positioning unwinds. This is one reason silver is often described as more volatile than gold. Its price can be influenced not only by real supply and demand, but by waves of speculative activity moving in and out of the market. Taken together, these structural forces show a market shaped by slow-moving fundamentals and fast-moving speculation existing side by side. The mining constraints, the industrial demand growth, and the deficit trends represent the deeper, more reliable story. The rapid price swings tied to news events, like the recent inflation report, represent the surface-level noise that can either align with those fundamentals or temporarily distort them. Understanding this difference is essential for any serious investor. A rally driven by strong structural fundamentals tends to be more durable. A rally driven mainly by short-term speculation tends to be more fragile. The challenge, as the next part of this story will explore, is that the two can look almost identical in the moment they are happening, and only careful analysis can tell them apart before it is too late. By this point in the story, two very different pictures of the silver market have emerged. One picture shows a metal supported by real, long-term fundamentals, shrinking mine supply, rising industrial demand, and a slow-building deficit that few casual investors ever hear about. The other picture shows a market reacting emotionally to a single inflation report, driven largely by retail traders chasing a fast-moving headline. The real risk, according to many experienced analysts, is that most investors cannot easily tell these two pictures apart in the moment, and that confusion is exactly where costly mistakes tend to happen. The specific danger being highlighted throughout this story is not that silver will collapse, or that the inflation report was fake, or that the rally is meaningless. The danger is more subtle than that. It is the risk of mistaking a short-term, emotion-driven spike for the beginning of a long-term trend, and making financial decisions based on that mistaken belief. This pattern has repeated many times throughout financial history. A surprising piece of economic data triggers a sharp move in an asset. Media coverage grows. Search interest rises. New investors, many of them unfamiliar with how volatile silver can be, enter the market near the top of the excitement, believing they are just getting started on a much bigger trend. Then, as institutional players finish adjusting their positions and the initial emotional reaction fades, the price often cools, sometimes sharply. Those who entered late without understanding the difference between a structural rally and a speculative spike are usually the ones who feel the impact the most. There's another layer to this risk that deserves close attention: leverage. Many newer investors do not buy silver directly. Instead, they use financial products that allow them to control a larger position with a smaller amount of money. While this can amplify gains during a rally, it can just as easily amplify losses during a reversal. In fast-moving markets like the one triggered by this inflation report, leveraged positions can be wiped out in a matter of hours if prices move the wrong way, even if the long-term outlook for silver remains positive. Professional traders are often aware of this risk, which is why some of them behave in a way that might seem confusing to outside observers. Even as prices rise and headlines celebrate the rally, Some experienced market participants quietly use options and other tools to protect their existing positions against a possible pullback. This is not because they believe silver has no future. It is because they understand that short-term price action and long-term value are two very different things, and that protecting capital during uncertain moments is just as important as capturing gains during confident ones. This is the heart of the warning at the center of this story. The inflation report was real. The structural case for silver, built on years of supply constraints and growing industrial demand, is also real. But the sharp, sudden rally that followed the report may be running ahead of what the fundamentals alone can support in the short term. When price moves faster than the underlying story that justifies it, a gap opens up between expectation and reality. History shows that gap does not stay open forever. Eventually, it closes, sometimes gently and sometimes very suddenly. For business professionals, entrepreneurs, and wealth-conscious investors, the lesson is not to avoid silver altogether. The lesson is to separate excitement from evidence and to make decisions based on a clear understanding of both the long-term fundamentals and the short-term risks, rather than reacting purely to a single dramatic headline. The final part of this story will bring these threads together, offering a clear-eyed look at what serious, strategic investors should watch for in the weeks ahead, and how they can position themselves thoughtfully in a market where opportunity and risk are moving side by side.